Welcome back to the Deep Dive. If you've ever thought about starting a business in the U.S. or, actually done it,
Oh, yeah.
you've probably hit that wall of acronyms. LLC, S Corp, C Corp, partnership.
Hmm?
It gets confusing fast.
It really does. And the sources we looked at suggest this confusion isn't entirely accidental. It's systemic.
Right, so for you listening, the mission today is pretty specific. We want to pull apart one really fundamental idea.
Exactly. We need to separate two concepts that, honestly, almost always get mashed together. A company's organizational legal form
Okay.
and its tax status. They are not the same thing.
I like to think of it like the legal form is the car's body, right?
Yeah.
It's a sedan. The truck tells you how it operates, who's driving maybe.
That works.
But tax status.
Okay.
That's the engine. Gas, diesel, electric, and you can put different engines in similar cars.
That's a perfect analogy, actually. The organizational form, that's decided when you register with the state. It governs things like corporate rights, duties of the people involved, internal management.
So that's your LLC, your partnership, your traditional corporation structure.
Precisely. That's the body.
And the tax status, that's the
Right.
engine, dictating the actual tax obligations for the company and for the owners.
Yes. And these tax engines, they fall into two main camps, broadly speaking.
Okay, where are they?
You've got the pass-through regimes, sometimes called transit regimes. Here, the entity itself generally doesn't pay the tax. It sort of passes through.
Passes through to the owner.
Exactly. The profit, the loss, it lands on the owner's, shareholders, or partner's personal tax returns.
Okay, that's one camp. What's the other?
The corporate regimes. Here, the entity is a separate taxpayer. It has its own tax legal standing, files its own returns, pays its own taxes. A distinct entity in the eyes of the IRS.
Got it. Okay, let's maybe start with the pass-through ones. They seem like the default for a lot of smaller businesses.
Makes sense. The simplest of the simple is the disregarded entity status.
The name kind of gives it away.
It really does. For
Right.
tax purposes, the IRS essentially just disregards the entity. It's not treated as separate from its owner.
And this is the default for.
Usually for any legal structure with just one owner, so most commonly a single-member LLC.
Okay, so if I'm running my own consultancy as a single-member LLC, the LLC itself doesn't file a tax return.
Correct. It doesn't pay taxes. You, the owner, report all the business income and expenses directly on your personal Form 1040, usually on Schedule C.
So all the tax stuff, profit, loss, even the type of income, it just lands straight on my return.
Exactly. It's placed directly on you, the participant. It's simple, which is great, but it's also why people confuse the legal form and the tax status. The LLC gives you that liability shield.
Right, that's the legal form benefit.
But the disregarded entity status gives you the tax simplicity. Two different things doing two different jobs.
Okay, that makes sense.
Right.
Now, what if I bring in a partner? My single-member LLC becomes a two-member LLC. I'm not disregarded anymore, am I?
Nope. The moment you have two or more members, the default tax status flips. You generally default into the partnership tax status.
And that's governed by Subchapter K.
That's the one, Subchapter K of the tax code. You need at least two partners. And think of Sub K as, well, potentially the most flexible tax regime out there for multiple owners.
How so? Does the partnership itself pay tax?
Generally, no. Like the disregarded entity, it's passed through. Certain things are determined at the partnership level. It files an information return, Form 1065.
Okay.
But the final tax bill, that's still imposed directly on the individual partners based on their share.
Right, so let's just nail down that default for LLCs because they're so common.
Good idea.
Single-member LLC
Hmm.
defaults to disregarded entity for tax.
Check.
Multi-member LLC defaults to partnership tax status under Subchapter K.
Check. That's the standard path. Seems pretty straightforward.
It does seem clean. But you mentioned choice earlier. If Sub K is so flexible, why would anyone choose a different tax status? Like, why would an LLC elect out of that default?
Good question. It often comes down to factors beyond just the immediate tax calculation. Maybe liability concerns at a larger scale, or how you want to attract investment, or even specific state tax reasons that might push them towards the other big category.
The corporate regimes.
Exactly. Which brings us to the classic. The Subchapter C Corporation, or C Corp.
Right, the standard corporation.
Yeah.
Think big business, Fortune 500.
Yeah.
And it's kind of famous for, well, a pretty significant tax drawback.
The C Corp is where the business truly becomes a separate legal and tax entity, independent standing. And yes, the big headline is two-level taxation, often called a double taxation.
Can you walk us through that? What does that actually mean for the money?
Okay, imagine a C Corp earns, say, $100 in profit, level 1. The corporation pays corporate income tax on that $100 profit. Let's say the rate is 21%, so it pays $21 in tax.
Okay, $79 left.
Right. Now, the corporation decides to distribute that remaining $79 to its shareholders as dividends, level 2. The shareholders receive that $79 and they have to report it on their personal tax returns.
And pay personal income tax on it. Again,
on the same original dollar of profit. That's the double tax hit.
ouch. That sounds inefficient. Why would anyone choose that?
Well, C-Corp have major non-tax advantages, especially for larger, complex businesses. Think robust liability protection, the easiest structure for raising capital from diverse investors, simple transfer of ownership through stock.
So you're trading tax efficiency for legal and operational benefits sometimes.
Precisely. It's a trade-off. But that double tax burden was significant enough that Congress created a sort of hybrid option.
Trying to get the best of both worlds.
Kind of. Enter the subchapter S Corporation or S Corp. It aims to give you the corporate legal structure, but with, ideally, pass-through taxation.
So legally, it's a corporation.
Yes, it's fundamentally a branch of C-Corp law. All the C-Corp rules generally apply unless the specific S-Corp provisions override them.
But the tax treatment is different. It aims for single-level taxation.
That's the goal. To mimic a pass-through, pushing the tax liability primarily to the shareholders. But the way it does this, well, it creates some unique complexities for the owners.
Because the owner isn't just an owner, right? They're treated in a sort of split way.
Exactly. The S-Corp shareholder, especially one who works in the business, is seen as contributing both labor and capital.
Okay.
This means the S-Corp must pay the shareholder employee a reasonable wage or salary for the work they actually perform.
And that wage is taxed like any normal salary,
Yeah.
right? Income tax, payroll taxes.
Correct. Standard employment taxes apply to that reasonable salary. Then, if there are profits left over after paying that salary and other expenses, those remaining profits can potentially be distributed to the shareholders as dividends or distributions.
And those distributions are the potential prize because they might be taxed more favorably.
That's the hook. Under the right circumstances, these distributions might be taxed at lower long-term capital gains rates. And critically, they are generally not subject to self-employment taxes, Social Security, and Medicare.
Okay, I see the appeal. That difference between salary and distribution tax treatment is huge.
It's the main driver for choosing S-Corp status for many small businesses. But, and it's a big but, making that distinction correctly and defending it. That's where the trouble often starts. We'll definitely circle back to that.
Okay, but before we get into the weeds on S-Corp problems, let's just loop back to the flexibility idea. We said LLC's default pass-through.
Right. Disregarded or partnership.
But can they choose to be taxed like a corporation?
Absolutely. This is key. The IRS allows entities, particularly LLCs, quite a bit of flexibility through elections. An LLC can file a form, it's called checking the box, to be taxed as a C Corp.
Okay.
And if it qualifies, it could then subsequently file another election to be taxed as an S Corp.
So my LLC, legally an LLC under state law, could function like an S-Corp for federal tax purposes.
Precisely. The legal form, the body, stays LLC, but the tax engine changes. Likewise, a partnership can elect C Corp status and then potentially S Corp status, and a state law corporation defaults to C Corp tax status.
But can elect S-Corp status if it meets all the S-Corp requirements.
You got it. The organizational form and the tax status are distinct and often selectable.
Which brings us back to that core tension you mentioned, the benefits of one system, like corporate law's liability shield.
Can create disadvantages in the other, like the C Corp's double tax, or, as we'll see, the S Corp's complexity.
You pay for that shield, either in dollars or in headaches.
That's a good way to put it. A complexity premium or a cash premium.
All right, let's shift gears slightly. According to the research, if maximum tax flexibility is the absolute top priority, which regime wins?
Hands down, the partnership tax regime, Subchapter K.
Why is that? We established it's pass-through, but what makes it so flexible?
Think of Sub K as like financial modeling clay.
Yeah.
The corporate forms, C or S, are more like rigid Lego blocks. Sub K allows for incredibly tailored economic arrangements between partners.
Arrangements that you just can't do elsewhere.
Exactly, or at least not without incredibly complex and expensive workarounds. This flexibility is vital for things like joint ventures, real estate deals, businesses where partners contribute very different things. Maybe one brings cash, another brings know-how.
Can you give a specific example of that flexibility in action?
The big one is the ability to handle non-proportional allocations of profits, losses, deductions, and credits.
Meaning?
Okay, in a C Corp or an S Corp, if you own 30% of the stock, you generally get 30% of the dividends, 30% of any distributed losses, etc. It's locked to your ownership percentage.
Pretty rigid.
Very. But under Subchapter K, the partners can agree in their partnership agreement to split things differently. Partner A put in 80% of the cash, but Partner B does 90% of the work. They can agree that Partner B gets, say, 60% of the profits for the first 5 years.
Even though they only own 20% based on capital.
Yes. As long as it has substantial economic effect, which is a whole other topic. But the point is that customization, those special allocations, is unique to Sub K. It's a huge advantage.
That's powerful. What else makes Sub K stand out?
Several key transactions are typically tax-free in a partnership context when they often are taxable in a corporate one.
Like what?
Generally, forming the partnership itself, contributing property in exchange for a partnership interest, is tax-free. Taking property out of the partnership, distributing assets back to partners, is also often tax-free.
And trying to move assets in and out of a C Corp without triggering tax.
Can be an accounting minefield. Sub K handles these common business flows much more gracefully from a tax perspective.
Okay, so Subchapter K sounds like the unsung hero of tax flexibility for multi-owner businesses.
In many ways, yes, especially for complex arrangements.
Yes. When you browse online or talk to maybe less specialized advisors, the S Corp often gets pushed really hard. Like it's the secret weapon for small business tax savings.
Oh, yes, the S Corp hype. This is where the sources we reviewed issue a really strong caution.
Warning.
A significant one. While it's heavily marketed, the S Corporation is described in some materials as potentially the most problematic, the most fickle or capricious tax regime.
Wow.
Because it comes loaded with the largest number of strict eligibility requirements and ongoing operational restrictions. And violating these rules, even accidentally,
Can blow up the whole structure.
instantly. If you violate an S Corp rule, the S election terminates, often retroactively to the beginning of the year. And where do you land?
Back in C Corp territory with the double taxation.
Exactly. Overnight, it can be catastrophic.
Okay, we need to unpack these S Corp restrictions then. What are the big ones?
There are several key ones. First, limited number of shareholders. You can't have more than 100.
Okay, 100 is still quite a few for many small businesses.
True, but it's a hard cap. Second, and this is crucial, you can only have one class of stock. Meaning all shares must have identical rights to distribution and liquidation proceeds. You can't have preferred stock with different dividend rights or shares with different voting rights. Everything has to be economically identical on a per-share basis.
Yet limits financing options, potentially.
Significantly. And third, perhaps the biggest hurdle for many, relates to eligible shareholders.
Who can own S Corp stock?
Generally, only U.S. individuals, certain estates, and specific types of trusts. Crucially, you cannot have partnerships, most corporations, or non-resident aliens as shareholders.
Whoa. Okay, so no foreign investors, no holding company structures.
Generally, no. That immediately rules out S Corp status for businesses seeking international investment or those using more complex tiered ownership structures. It really limits it to simply primarily domestic ownership.
So it's structurally quite rigid compared to a partnership or even a C Corp in some ways.
Absolutely. And while it promises that single-level tax, the sources argue those benefits are often, quote, localized and parochial. Meaning the headline benefit looks good on paper, but when you factor in the administrative burden, the salary requirements, the risk of termination, the net benefit might be much smaller than advertised, or even negative for some. Small S-Corp might still face a sort of de facto double tax if they struggle with the salary rules.
Which brings us back to that core S-Corp issue, the split between salary and distributions.
Yes. The whole game is minimizing payroll taxes on distributions by characterizing profit as return on capital, not payment for labor.
But you said the owner has to prove that split.
That's the kicker. The burden of proof is entirely on the taxpayer, the shareholder employee. Let's take your example. A consultant, S-Corp, makes a $100 K profit. They are the main, maybe only, service provider.
Right. I want to pay myself a low $20 K salary, take $80 at distribution, save on self-employment tax.
The IRS is going to look very closely at that. They'll ask, what would a business have to pay an unrelated third party to perform the services you performed? What's a reasonable salary for that work in your industry and location?
And if they decide, based on market rates, that a reasonable salary is actually $75,000.
Then they'll argue you underpaid your salary by $55,000. They can recharacterize $55,000 of your $80,000 distribution back into wages.
Which means I suddenly owe back payroll taxes on that $55K. plus interest, plus penalties.
Precisely. The shareholder must be able to justify, with data and documentation, why the salary they paid themselves was reasonable for the labor provided, and why the remaining profit genuinely represents a return on the capital invested in the business.
And if the business's success is almost entirely due to my personal skill and effort, like a doctor, lawyer, consultant.
That justification becomes extremely difficult. How much of that profit is really from capital, like your office equipment, versus your irreplaceable expertise in labor? It's a very tough line to draw and defend.
So it's not just filing forms, it's an ongoing defense of your compensation structure.
Every single year. The potential tax savings are real, yes, but they hinge completely on meticulous record keeping and your willingness to potentially fight the IRS over reasonable compensation. That makes the S-Corp quite risky, especially for service businesses where the owner is the primary value generator.
Okay. Wow, let's try to wrap this up for the listener. We started with that fog of confusion around LLCs, core, taxes.
Right. And the biggest takeaway, I think, is to shift your focus. Stop agonizing over just the legal acronym LLC versus Corp.
And focus instead on
Deliberately choosing the tax regime, the engine that best fits your specific situation. Consider how many owners. How complex do profit splits need to be? And crucially, what's your tolerance for rules, restrictions, and administrative work?
So if you need that super customized profit sharing, multiple owners, complex deal, Subchapter K partnership is likely your best bet.
Generally, yes, for flexibility. If you need that rock-solid legal structure for major scale outside investors, maybe IPO path, the C Corp is the traditional, albeit potentially tax-heavy route.
In the S-Corp.
The S-Corp. It's that tempting middle ground. It can offer tax savings, but it comes wrapped in layers of red tape, strict eligibility rules, and that constant burden of proving reasonable compensation. It's not the simple magic bullet it's often made out to be.
Okay, so here's a final thought to leave everyone with, building on that S-Corp point.
Let's hear it.
If the primary financial allure of the S-Corp hinges entirely on your ability to meticulously document and defend, year after year, the precise split between your labor income and your capital income to the satisfaction of the IRS. Is that potential tax saving really worth this significant administrative headache, the inflexibility, and the ever-present risk of having your S status yanked away, potentially costing you far more in the long run? That's the real question to ask before jumping into an S-Corp election.